Good afternoon, ladies and gentlemen, and thank you for taking the time to join this webcast and the opportunity to hear from Tony Dwyer. My name is Kevin Vandermeer, and I have the distinct pleasure of introducing our keynote speaker, Tony. Tony is known to many of you. Tony Dwyer is our Chief Market Strategist. He's based in New York and has over 30 years of experience. He is widely sought after around the globe by money managers, hedge fund managers, pension funds, endowments, and you've probably seen him on CNBC and Bloomberg. Tony has this really unique ability to take economic data, which is sometimes boring and complex, and really distill that down into making it interesting and actionable. And so today you're going to see that. Tony, I've had the chance to travel with Tony. Tony is a really great guy. He has 2 adult children. He resides in New Jersey. He's a scuba diver and a pilot and just an all-around great guy. So thank you, Tony, and we look forward to your thoughtful comments. Over to you.
Well, thanks, Kevin. Thanks, everybody, for tuning in. And I can't wait for the time where Kevin and I can come and visit people. This is aggravating, I'm sure, for everybody. So I think what I want to do is start out with a current opinion. So in case something happens and you have to jump off, many times when I'm in town, in the various cities, talking to you all and giving presentations, and usually when I'm on TV, for the better part of the last 10 years, I've looked into the camera or looked into the audience and I've said, follow the guys printing the money. The Fed, the folks printing the money keep telling us what to do. They're literally telling us what to do. And so many of us sit there and try to figure out if it's right or wrong, good or bad, instead of just following what is. They're backstopping every area of credit. The Fed has literally said they're just going to print money. So you can have volatility. We currently think we're in this consolidation period that could last another few weeks. But they're telling you that they're going to backstop the credit markets. And every time they open their mouth, they tell you that they're still worried about the economic backdrop and that they're going to continue printing money. So what I'm going to do is I'm going to take you really quickly through how that progressed and how our call for 2020 has changed because of it. So as we went into 2020, as you hopefully know through your advisor, we, on January 20th, pulled in our horns. We advised taking down risk. We thought that there was a little bit too much exuberance out there in the marketplace, and we wanted to take down any excessive risk. It had just been too much. And I did not think that the market was going to collapse 34% because of a virus. The virus was just coming onto the scene. And once you started to drop and it started to become evident, I was actually out in San Diego. I think I was probably one of the last talks that was given in a public environment in California in March. And it was clear to me that there was a bigger thing at hand when we were shutting down the economy. So as we shut down the economy, we go into mid-March. The Fed hasn't decided what they're going to do yet. I think they cut by 25 basis points. I looked at a camera on Closing Bell on CNBC, and I said they're going to have to cut a hell of a lot more than 25 basis points. So, we didn't know what the COVID-19 was. We didn't know how it was going to spread. We didn't know how the economy would react to being literally shut down. And we didn't know what the Fed was really going to do and how long it would take them to get the joke of what it means when you're shutting down economic activity. So we had that final whoosh into the panic low. I think we did a good job of identifying the proximity of a good relief rally, which historically has been a median 17%. And that's where we made, those were the good calls. With everything, there's good and bad. We were wrong in thinking at that point, after that initial relief rally, that the market would go down and retest. Because after the low on March 23rd, the Fed came out and they said that they were going to buy corporate debt. Now, the market was oversold, and any time the market has been as oversold as we found it then, it's only happened, I think, 5 or 6 prior times, and in each of those periods, you went back to at least within 5% of the low. Obviously, this time you didn't. And what changed that and what changed our call was the progression of the Fed. And this is really important when you're thinking about the long-term implication of your portfolio. The Fed on like I said, in late March said that they were intended to buy investment grade debt. And then on April 9th, they announced that they intended to buy high yield debt, right? It's extraordinary. That's a game-changing decision, because what happens in a recession is companies get into trouble and can't raise money. Wait till I show you this chart. So let's look at what those decisions have meant to the investment grade bond market. That on the bottom half of this chart, on the top half, the orange line is the investment grade corporate bond yield, and on the blue line is the 10-year treasury yield. On the bottom half of that chart is simply the spread between the two. You can clearly see when it got to about 375 basis points by March 23rd that the Fed had a dramatic impact on turning the tide of that. As you can see that it had that initial decline down to about 200 basis points, where it then rested for a little bit. So that's nice. It's great that corporate bonds had improved. The real story comes into this slide, where the investment grade issuance has been extraordinarily broad. There's been $1 trillion of corporate credit new issuance. That almost matches what happened in all of 2019. $1 trillion at historically low yields. That funds corporate America to get through the pandemic. And as we know, that's fueled a lot of the spending that has kept businesses afloat during this period of time. And what that also did on April 9th is it led to an improvement in the high yield debt market. Those corporate bonds that are typically the riskiest of corporate bonds. Again, on this chart, you can see the top half shows you that the speculative grade debt yield peaked and then around 11.5%. And on the bottom half, the spread to treasuries peaked at about 1,100 basis points. This is where it's so important to understand how the Fed's impact into the credit markets turned the tide. We have the worst economic data, which I'm going to show you a couple data points in a minute, the worst economic data in the history of the United States of America in many cases, and at least as bad as the great financial crisis in 2008 and 2009 and the Great Depression in the 20s, in 29 to 32. So when you think of that, it's mind-blowing. And what the Fed did amazingly quickly, and it's what's different about the market today, is you have a Fed that knows the markets. You got Jerome Powell was at Goldman Sachs and involved in private equity for the bulk of his career. He knows what banking and shadow banking and credit markets look like and how it's important to have them open. You have Neil Kashkari, the president of the Minnesota Fed. I actually met with him one time as a fund manager for PIMCO. But he was part of TARP and the solution during the great financial crisis. He knew what to look for, right? So what you have Steven Mnuchin, who the Treasury Secretary, who also was a Goldman Sachs guy. So it's not a comment on Goldman Sachs. It's a comment on people that understand how important the credit markets are to keep flowing. So what you saw is the improvement, the sharpness of the reaction by the Fed created a much less severe crisis than otherwise would have been. So what that's done, when you look at the top half of this chart is the spread for investment grades against treasuries. The bottom half is the spread against high yield. So I took the bottom half of the last two charts and put them together because I wanted to show you that the high yield market has gone all the way back to mean on the bottom. And since that, the progression of the Fed, we've wanted to follow the Fed. Not only did they announce that they were going to buy high yield debt on April 9th, even the next two news items to me are really extraordinary. On the April 28th FOMC meeting, at the press conference, Jerome Powell got up to the mic and he said, there's no dollar limit to our support of the credit markets. And that's just a mind-blowing thing. He talked about using all the tools in his arsenal. Right there, that took a retest off the table, full stop. When he's telling you that you have QE infinity, you cannot expect that kind of drop. It would be historically, I think, inappropriate. So what happened is you were in this trading range until a really key event. And that key event was when Jerome Powell went on 60 Minutes. Now, most people would look at the market and say it never retested the low, and that's true. But areas of the market did, the economically sensitive areas of the market, transportation stocks, the airline stocks, the entertainment stocks, the bank stocks on May 14th, they had all tested the low. If you remember, I don't know if you remember, but Wells Fargo was rumored that Thursday to be having to lower their dividend, and Goldman Sachs was rumored to be taking them over, kind of a la great financial crisis-esque, you know? And so the banks were getting smoked. Jerome Powell comes on to CBS's 60 Minutes that Sunday. He looks into the camera and he goes, "We're just printing money." He didn't use QE. He didn't use all these funny terms that we've heard from monetary authorities over the course of the last, my 35 years in this business. No, the guy literally said, "We're just printing money." And the anchor kind of looked at him and said, "Well, isn't that going to have a consequence someday?" And Jerome Powell, the chairman of the Federal Reserve, looked at him and said, "Now is not the time to worry about that." They have two mandates at the Fed. They have full employment, which is around a little under 4% now. We're nowhere near that. We're not going to be near that in the U.S. for another year and a half to 2 years at least. And stable inflation at 2% core inflation. We haven't been there this entire period in the recovery. So there's no way that we're going to get to those two mandates in the next 2 years based on statistical analysis, which means what he said on 60 Minutes is we're literally printing money, and we're going to do it until we get to those two mandates. And that's not happening for 2 years. Really extraordinary support of risk. Again, forget whether it's right or wrong, good or bad. It's wrong and it's bad, in my opinion, down the road. You know, somebody's going to have to pay this money back. Forget about it. It is what it is. We have to invest on what is, not what I think is good or bad, because what my opinion on the implication doesn't matter. We just know that they're doing this, right? So what that has led to is that when you look at this slide, I can't even believe this is money supply. This is M2 in the U.S. on year-over-year growth. You are more than 2 times any growth rate in the history of the data series. In the history of the data series, going back to 1940, you've never even had anywhere near this amount of money growth. The U.S. savings rate is currently at 33%. So here's the point of this. The market got ahead of itself. About 10 trading days ago, we put out a research piece calling the market had hit our near-term target of 31.50 when it broke out of the trading range. I'm going to show you that in a second, how we got there. But whenever you think, this is why the market is not reacting to an uptick in COVID cases in the U.S., again, in Florida and Texas. This is why it's not reacting to the Chinese conflict with the U.S., the developing conflict again with the U.S. It's because there is so much money that it's waiting for a vaccine so it can come back into the economy, right? And until then, it's finding its way into risk assets. So this money supply reading really is important in driving what the environment's going to look like once we have a vaccine. And our team, our biotech team here at Canaccord, thinks that's going to be sooner rather than later based upon the number of trials that have been pulled forward. So the money supply growth truly is extraordinary, and that has led to an easing of the tighter financial conditions. If you've been to my talks in town, you know that this is the Chicago Fed National Financial Conditions Subindices that measures 105 credit stress indicators. When it's going up, it means there's increasing stress. When it's going down, it means there's lessening credit stress. And as you can see, you got that spike up in March and early April, but now that's being reversed. This is a weekly data series. There's obviously an improvement in the data series because of the Fed intervention, the amount of money coming into money supply, and the amount of money coming into corporate balance sheets because of corporate credit new issuance of $1 trillion. There's extraordinary amount of money around, right? And what that is allowing for is an improvement from the worst case level of the unemployment rate. So honestly, you don't need me to tell you that you're off the worst levels of every economic data series that exists because they got so bad. It's not hard to improve from zero. So today, the leading economic indicators have bounced. Yesterday, the Philadelphia Fed manufacturing activity obviously out of the mid-Atlantic region hit a record uptick because it had a record downtick the month before. So we're not seeing anything that would be unusual given how much the pain there was. But what we are seeing is typically when you make a peak, it doesn't go back and get worse. It keeps coming down. So what you've seen because of the pessimism from this whole COVID thing while we're all working and staying from home, the drop was extraordinary in these Citigroup Economic Surprise Indices. In other words, the U.S. Citigroup Economic Surprise Index got down to the level and rivaled the level of late 2008. It has since had an extraordinary jump. It's at a record level of 101. So again, people got too skewed into the negative, and now they're coming back more towards reality as you get some of these data series to come in better than expected. So again, we got offensive and upgraded our market view back to offense. Again, remember we downgraded it in January. You can see where that is on this chart. And it's frankly, it's better to be lucky than good. Pretty close to the high. And then we just, once you broke out of that trading range, if you look in that trading range, the move right before you broke out of it, that gap in this chart on the right, I'm not sure, but I'm hoping you can see my cursor right there. That's the 60 Minutes interview. That's the interview that changed the bull market. It was the first half of the bull market from the March 23rd low into early April. That was the COVID-19. I call that the COVID-19 bull market. That's when the work from home, stay at home stocks had been responding so well. The move off of that 60 Minutes interview, as soon as the market heard that they're going to print no matter what for a long duration, you got a major reversal in what we call the economic reopening sectors, which is our favorite sectors. Those sectors that do well when you're anticipating a recovery from a recession. They would be the financials, primarily the banks, the industrials, the materials, the consumer discretionary, even the energy, anything that's related to economic improvement versus a defensive backdrop. A defensive backdrop is what the mega cap FANG stocks benefit from. They always grow, so people love them in any economic environment. But when you really, I showed you money supply, I showed you corporate credit new issuance. When you do get a vaccine and that money begins to go back into economic activity, there's a hell of a lot of money there. I want to be long economically sensitive names. We do believe, as you can see, when it got up to 3,200, it hit our near-term target. We expected a pullback. We got the pullback. So we would add, our input has been to institutions to add the risk on weakness. So one more slide here. This slide shows you what the potential is and why we called for a little bit of a pullback. As you can see on those arrows on the bottom half of that chart, the top half is the S&P 500. A weekly graph. The bottom half is a 10-week rate of change. The only time that you ever had a similar spike in the 10-week rate of change on the S&P 500 was the 40%, might sound familiar, we're up 39% at the peak of this move. The first 40% ramp in the market in 2009 led to a pullback in June, also may sound familiar. Market bottomed in March, went up 40%, pulled back in June, and then made the next leg higher. We believe that we're in the similar environment to today. So there is a tremendous, I'm sorry, Kev, one more chart, and then I'll stop droning on. This chart is a terrific one, too, because it shows you some of the upside potential. This chart is why we have a 3450 tactical target on the market. I say tactical because when 90% of the S&P 500 stocks got above both their 10 and 50-day moving averages, you can see that in the blue arrow, right? It's pretty rare since 1990. It's even more rare when you do that for 10 straight days. Those are the green arrows. What you'll notice is that doesn't happen at the end of a move. It typically happens at the beginning. So our view is that you're going to see a little bit of near-term volatility as the market tries to consolidate the gains. Ask your advisor for the reports. We've written about that in the last 10 days. But when you get periods of weakness where it feels like things are going to kind of get hit and keep going down, we want to add the risk for that 3,450 target on that weakness. So with that, Kev, I'd love to open it up to any questions that may have come in.
That's great. Thanks for that great presentation. So we have a number of questions. We'll try to get through them as quickly as possible. So the first is just, clearly most of us that are listening right now are in Canada, and obviously the U.S. markets have had just this tremendous run, coming out of the great financial crisis. And so how do you think about investing around the world, but maybe specifically whether we should be in Canada or in the U.S. as Canadian citizens, I guess, if you will?
Sure. So it's funny you say that. I said it yesterday too. I should be a Canadian. I should have dual citizenship for the number of times I'm in Canada. I love coming to Canada. So anyway, what you'll notice is that yesterday, China Beijing shut down their schools. And they shut down their schools because of, a little bit of a return of the COVID-19 cases. So largely the global economy is still shut down. But what you'll also notice is Great Britain, China, India, the Eurozone, the U.S. announced that they're buying individual corporate bonds. There is this massive push of money into the coffers. It's not going into the economy yet, Kev. It's going into the coffers. So what's happening is I want to be exposed to the more economically sensitive geographic regions, Canada being one, in a time when that money starts to go back into economic activity. So that's why we're more in favor of the part of the economic reopening idea. It is geographic region as much as it is sector and area of performance. So when the economy gets better, I want to be long Canada. I want to be long commodity-based currencies, and I think there's a lot more upside there than people are pricing in.
Right. Okay, great. Next question. None of us get a chance to vote, maybe thankfully, on the election that's coming. And Biden, by most measures, I think is leading. I read one poll today by 8 points. How do you think the market reacts? How are you thinking about the election? If Biden were to win, unseating a sitting president in a second term is unusual. How are you thinking about that?
Well, it's unusual as long as you're not in a recession, right? And we've kind of had a shutdown and a bear market that we've recovered both. We're recovering in both, which is probably good news for President Trump. Honestly, Kevin, I don't think it's going to matter who gets in. Eventually, there's going to have to be some degree of increase in taxes. Somebody's going to have to pay for all this money printing. And usually it's corporations and the top 20%. So, people got the last election all wrong. If you told people what the results were going to be, they would have bet it differently. I don't ever want to bet somebody else's money on a guess. So at this point, I think what's really happening is the market's trying to digest what all this money printing means. And a Biden presidency is probably going to lock in some kind of very quick tax hike, whereas a Trump presidency would not. And at this point, Biden in the lead has helped create some of this indigestion that's causing the consolidation period we've been looking for.
Right. Okay, great. Next question is just, you've been doing this a little while. You've seen a few cycles in your time, and this recession obviously is very different than many others in terms of it being almost a pause, forced on by governments, and rightfully so to protect us all. How has that changed your thinking, and maybe how are you thinking about this recession as it were, given the economic data is kind of off the charts, if you will, in terms of how bad it is, versus other recessions. How are you thinking about that?
Well, what's most unique about this one, Kevin, is people aren't supposed to make more money if they're unemployed in a recession. So there was a study that was out today. I forgot which place it was from, but it showed that the biggest we may have to there, and on CNBC there was Senator Portman was interviewed, and they're coming up with a plan to create this. This is a beaut. They're coming up with a plan to incentivize people to go back to work because they're making so much more money between unemployment and the $600 in the CARES Act. They're making so much more money unemployed that employers can't get them to come back.
Right.
Right. So it's historically unique to have a recession where everybody's making more money, which is where this money printing's coming from. And that's my whole point of how the recovery could be much sharper than people expect, because as that money has to go somewhere. It's going to have to be put to work. Right. Whereas it's already plugged the hole. Now as the economy reopens, let's see how it gets put to work.
Right. And I think we've talked about it a little bit, but just, obviously the U.S. economy is really driven by the consumer. And in many ways, the consumer this time is in better shape than they were during, the financial crisis.
Yeah. Well, so here's the I looked at a really interesting chart yesterday. If you look at the interest expense to GDP for the United States, it's right near the lowest levels in history, despite the incredible level of debt. Why is that? Because as the higher yielding debt matures and you're taking out lower yielding debt, you can take out significantly more debt and even have a reduced interest rate. I can tell you personally, as I've told you all, when I give the seminars, I have a lot more debt than I had in 1996, but it's at such a lower interest rate that it cost me so much less a month. So I think that's a really important differentiator here, is the interest expense is so low that it should allow for the consumer and businesses to be in much better. You've raised $1 trillion in corporate credit new issuance, Kevin, at the lowest, right near the lowest rates in history.
Right. All right. Next question. I know that you're a U.S. macro strategist, but much of the audience that is joined us today is residing in the West, and specifically in Alberta. So you can't get away without sharing your view on oil, or at least some view on oil.
So my view on oil is really ignorant, as you know. But from a macro level, I pulled up a chart yesterday of the Baker Hughes oil rig count, which has gotten back to the level on a rate of change that it rarely gets to. And anytime it had gotten to that level in turns, it's more a sign of a bottom than a continued downturn. So, our view is, again, economically sensitive. When all this money, the money isn't just being printed in the U.S., it's being printed globally. At some point, there's going to be a hell of a lot more demand. And guess what happens when you have $36 WTI? It shuts down production. Right? So you're going to have a point where all this money is going to create global demand at a time where you're coming off of a historic shutdown in production. Again, I will defer to our energy analysts and people that know oil more than me. But as you all know, I'm kind of a common sense guy. I know I got to shut down a production and a pending big uptick in supply once you get the vaccine.
All right. That's good.
Uptick in demand once you get the vaccine, sorry.
Right. Maybe just comment on the U.S. dollar. We're obviously, if we're ever allowed to travel again, many of us, go to the States, and we got to exchange our Canadian dollars into U.S. dollars. Many of us are investing in the U.S. The U.S. dollar has weakened recently. Maybe give us a view on the U.S. dollar. Do you think that if Trump stays in, he's often talked about wanting a weaker dollar. So just some views on that.
Yeah. There was a real flight to quality during the pandemic and the global shutdown. There was everybody shut down. So there's only one place that had the flight to quality. And it was truly the U.S. dollar. Until the dollar is no longer a primary currency, it's going to be the dominant factor in a global collapse like that. Again, Kevin, if you believe in our economic reopening thesis, then you've got to believe that the dollar is going to weaken because it benefits those currencies that have more exposure to increased economic activity. Again, the commodity-based emerging markets and certainly Canada. So, again, we're in this kind of indigestion period of the market that could last a few more weeks. But I think, I think the Canadian dollar should do better relative to the U.S. dollar as long as the economy continues to reopen.
That's great. Maybe just that you've been super generous with your time, Tony, so we thank you for that. Maybe just one final question, and that is, if somebody has raised some cash or sitting on some cash right now, and is thinking about the market, and you've already shared with us that you think maybe the market goes sideways or even a little bit down, but longer term goes up. Where would you want people to start to invest, and how much would you necessarily put into the market right now?
So this is where I'm going to kind of break the ranks of people like me, strategists that go on TV and advise. I have no idea of what your risk tolerance is for the people on this call. Your risk tolerance, your time frame, how you invest, how much money you have. That's why I always really focus on asking you to call your advisor, right? There's no way that I could say, let's say, everybody on this call may have raised cash. I have no idea. I don't know your financial backdrop. So I'm not qualified to tell you individually what to do. What I can do is tell you what I'm doing with the institution. So number one, call your advisor to interpret what I'm going to say next and how it best benefits you. Number two, what I'm telling the institutions is during periods of weakness like last week, when you had a 7% decline and it looked like everything was going to get tanked again, that's when you want to add risk. And by add risk, I mean into the economic reopening areas that I mentioned before. Banks, I call it banks and tanks. Banks, industrials, consumer discretionary, equal weighted, not just Amazon, Amazon too, but not just Amazon. And of course, the energy and material names as well. We believe that this amount of money that's out there at some point is going to get put to work. So what we're trying to not do is play too cute for the next year to 2 years. We think the market's going to be significantly higher on this money pushing into economic activity. It's not going to be easy. There's going to be periods of volatility and indigestion, just like coming off of every major low. But, again, please call your advisor because only they know your risk tolerance and your time frame to hopefully take advantage of weakness as it might play out.
That's great. Well, that's a great place to end, Tony. Thank you for your time. We would just remind everybody on the call that Canaccord provides a wide variety of financial services. We are happy to do a comprehensive financial plan for you. We provide and advise on insurance. So looking at your full financial wellness and helping you make the best possible decisions, not only now, but for the future, whatever your situation whatever situation you might find yourself in. So thank you again, ladies and gentlemen, and have a great afternoon. Bye for now.
Thank you very much. And thanks everybody for tuning in. Have a great day.